Good evening and welcome to our 2024 first quarter financial market update call at Great Lakes Private Wealth. Good evening, this is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call, Changing Leadership. The call tonight is being recorded and will be on our website, greatlatesprivatewealth.com, shortly afterwards. Now let's get into what happened in the market in the first quarter and what we're seeing going forward. Pat Patin will give us some data, and then I'll update you with my outlook on the markets.
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we will be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. Starting off with some key stats for the call, the year-to-date price return of the S&P 500 through tonight is up 5.6%. The Dow Jones Industrial Average is flat, only up 0.3%, and the Russell 2000, the small cap index, is down 2.6%, and the NASDAQ Composite is up 4.3%. International stocks represented by the EFA index are up 2%, and gold, the leader in the clubhouse, is up 11.3%. Bonds represented by the Bloomberg Aggregate Bond Index total return are down 2.9%. During the last call, I highlighted the underperformance of international stocks and small U.S. stocks compared to enormous companies dubbed the Magnificent Seven. It seems that the market has taken notice of that recently, while small stocks represented by the Russell 2000 index have started to keep pace with their larger counterparts over the last few weeks. Our call is timely, as last week was the biggest weekly gain in equity markets since November. This rally came after the first 5% decline for the year and after the longest losing streak for the market since October of 2022. Despite there only being a 5.3% decline over those 30 days. Investors are trying to determine if the market has fully priced in reduced expectations for Federal Reserve interest rate cuts. This correction caught some off guard, but this was fairly typical in a given year. In fact, as you can see from the chart on my screen if you are following along on our webinar, the average year has more than 7 3% dips over 3 separate 5% mild corrections and 1 10% correction per year. Then you've gotten a bear market or a 20% plus decline every 3.5 years, like we last saw in 2022. This volatility is the price paid to invest in stocks over cycles and why clients have trusted us over the years to weather these storms. It's easy for investors to tell themselves that markets has run too far, too fast over the last year as a reason for not putting new money to work. But the reality is that market gains usually lead to more market gains. Recent analysis from Bespoke Investment Group looked at periods where the S&P 500 had seen one-year rolling returns of 30% or more. The data showed that the index typically outperformed the average period in the months and year ahead. 1 year later, the market was up 25 out of 27 times with an average gain of 16.9% compared to an average of 11.9% for all other periods. Household liquidity remains extremely robust. Currently, there is a record $6 trillion in money market funds. That is about 9% of disposable income in cash or money market funds. The usual peaks on the chart you see on the screen tend to be at the end of a recession and the beginning of a bull market, not before a big decline in the markets. So there is still cash on the sidelines that could get put into the equity markets. As with many election years, there tends to be volatility, but with a positive bias to it. As I mentioned on our previous call, when looking from 1928 to 2020 for election years, the market is up 83% of the time. As Dan will discuss further, we could be in a period where inflation remains sticky. To dig further, how do election years look when inflation is higher? If you cut the election year data I just mentioned and look at the period of 1964 to 1982 that had high inflation, The market performance numbers are even more astounding. In 1964, LBJ's election year, the market was up 16.4%. Nixon in 68 was up 10.8%. Nixon again in 1972, up 18.8%. Carter in 1976, up 23.8%. And Reagan in 1980, up 31.7%. Every single one was up double digits positive. The average return was 21%. If you take that whole data set out, do you know what the return is for the election years outside of those dates? 5%. That was a very populous period in the United States. People voted in these periods where fiscal spending was high, gives some interesting similarities to what we see today. While the stats give us some positive news, that could mean increased volatility. In that same period from 1968 to 1982, markets as a whole went nowhere. Yet every single election year was up double digits positive. In the other 10 years, the market lost 9% per year. But in real terms, with inflation, you actually lost 17% per year because inflation was so high during that time. This is an incredibly powerful data set. While that isn't the base case, we continue to monitor the inflation picture specifically and the impact it has on your investments. While politics is a factor in investing, going back 70 years, $1,000 invested in the market only when a Republican is president would now be worth $27,400 today. $1,000 when a Democrat is president would be worth $61,800, but $1,000 would be worth $1.69 million today if you put politics aside and stayed invested. This is just another reminder of how there are other more important factors than politics for investing, from earnings to interest rates and inflation, just to name a few. We were quite pleased with our portfolios and market results during the first quarter and last year. These were excellent times for most markets, especially in the United States. Dan and I continue to watch the changes in the financial and economic data and expectations of investors across companies, sectors, and economies. We will continue to keep our finger on the pulse of the markets and update the portfolios and you, our clients, accordingly. I wanted to close my commentary by sharing a recent note from one of our clients. Dan doesn't know I was going to share this. He's humble and probably would not share this on a call like this, but I felt like this sums up why everyone at Great Lakes Private Wealth takes so much pride and dedication in what we do for you, our clients. The note read, "Please tell Dan that if we had not met him when we did, I would not be where I am now. I don't know where I would be, but I don't think it would be in this lovely senior living building," which is very nice, by the way. "I am so thankful because he has grown our savings into the nest egg that allows for me to live in this nice place and have the life I have, and I'm very appreciative and just want him to know." These are the notes that keep us doing all we can for you all, and with that, I'll turn the call over to Dan.
Well, thank you, Pat. Good evening, everyone. When we get comments from clients like this, it makes everything we do so worthwhile. Of course, it's very humbling, and it makes me grateful for such wonderful clients that trust us every day to invest their hard-earned money and make sure their money is managed responsibly. I say this all the time, but Great Lakes Private Wealth is not just me. It's our whole team that's here to help you, our clients, every day. I also want to take a moment to express my heartfelt gratitude to everyone as we celebrate our one-year anniversary as an independent firm. It's been an incredible journey, and your trust and support have been instrumental in our success. Thank you for entrusting us with your hard-earned capital and allowing us to be a part of your financial journey. We look forward to, of course, many more years of collaboration and prosperity together. Now let's get to the markets. The first quarter in the market was one of the best we've seen in many years. In 2023, we had a great year, and we've started off 2024 continuing the momentum we had last year. The only problem for many investors is not every stock has participated. Last year, the stock market was dominated by the Magnificent Seven stocks. In 2024, it's now the Magnificent Five stocks, with Apple and Tesla not participating. An amazing fact is that the market was able to go up in the face of higher interest rates. This almost never occurs, and if it does, the market rally does not last very long. If you remember from my call last November, we said we thought the market was very oversold and was poised to go higher. We had just experienced the invasion of Israel by Hamas on October 7th, and many thought this would lead to much higher oil prices and a war in the Middle East. When you have these types of big geopolitical events, no one can predict how it will really affect the global economy. As most of you know, on my call in early November, I was very bullish on the market. We added money to the market in October because of my belief that the Federal Reserve was done raising interest rates. Since November, the Federal Reserve has not raised interest rates. So my prediction that we were done with interest rate increases has proven correct. Well, at least for now. In fact, the Federal Reserve will meet today and tomorrow, and I'll predict that they will not raise rates at this meeting. Their commentary will be slightly more hawkish than we've seen recently, meaning that they will tell us how important it is to stay vigilant against inflation, and that until the employment picture softens and we have inflation back at 2%, they will keep interest rates elevated. I cannot stress enough that I believe the two most important things we need to watch going forward to give us the best clues as to what the direction of the stock market will take in the coming months is, first, the level of inflation. Is it going up, down, or sideways? Second, the second most important data point to watch is the unemployment rate, or how many new jobs are being created month to month. This information is critical as to how the economy is really doing. This is why the stock market is hyper-focused on this information right now. Let's talk about this issue of inflation and how it relates to the stock market. Why is it so important? The reason it's so important is because inflation has so many negative effects on the health of the economy. If companies have to pay higher wages and higher prices for the items that go into making their products, then their profit margins get squeezed, causing them not to make as much in earnings. If profit margins are getting squeezed, companies usually have several levers they can pull to protect their profit margins. They can raise the prices of goods they sell. They can lay off employees and cut costs. They can buy new equipment and produce goods more efficiently. The other very negative effect of higher inflation is on every American's pocketbook. When you go to the grocery store, the price of food and goods is outrageous. I purchased a new air conditioner a month ago, and it was triple the price that it was 4 years ago. If consumers have to pay more and more for everyday items, then that leaves them with less money available for discretionary items like vacation, getting a new car versus keeping an old car. You get my point. If Americans are not consuming, then the economy can experience what we call stagflation. Stagflation is persistent high inflation combined with unemployment and a stagnant demand in the economy. Stagflation is where prices are going up, but the economy is not growing. That is potentially the worst scenario possible, but by no means the default scenario. Let's review the CPI readings of the first 3 months of 2024. The inflation rate has stayed stubbornly high. There's a couple of main reasons why it continues to stay elevated. In this chart you see that we put on the screen, you see that recently car insurance for homes and cars is up over 20% in the month of January. The January CPI was up 0.3% month over month and up 3.1% year on year. In February, the CPI was up 0.4% month on month and 3.8% year on year. And March's CPI was up 0.35% month on month and was up 3.8% year on year, and the same as it was in February and March. Shelter and food have been two of the biggest contributors to inflation this year. Shelter includes hotel prices, single-family homes, and multifamily apartments, and it also includes rent. In February, it was energy and shelter that led to inflation. In March, it was again shelter up 0.4 for the month and energy up 1.1% that led to the increase. You can see a theme here for the year so far. Whenever we see inflation strong, we see many of the commodities with strong price momentum. You may have heard that cocoa is up 186% over the last 12 months. Look out for candy bar prices this coming Halloween, because I have a feeling prices for candy bars are going up. Copper is at a new high in price. Gold's at all-time highs. These are all signs that inflation may be with us for a while. Typically, when interest rates are going up, gold goes down in price. The exact opposite has occurred this year. There are several reasons economists have come up with this. I'll just share a couple of what I think are the key reasons for gold's strength in the face of these higher interest rates. Remember, higher interest rates are supposed to slow the economy down, and that in turn will slow inflation down. Well, that has not happened this year. Why has gold rallied so strongly this year? First, even in the face of higher interest rates, inflation stayed higher than expected and has stayed stubbornly elevated. Investors typically want to hedge against inflation, and gold has proven in the past to provide protection against inflation. This is why I believe you've seen such strong momentum in gold. The second reason is central banks around the world are accumulating gold as a protection against the fallout of foreign currencies and the potential weakness of the US dollar. Here is an amazing statistic I read the other day. According to the World Gold Council, the total amount of mined gold throughout history is estimated to be 244,000 metric tons. 2/3 of that gold has been mined since 1950. In fact, if you put all the gold ever mined, it would be a cube 22 meters on each side, which is 66 feet by 66 feet by 66 feet. That would fit within an Olympic-sized swimming pool. It's hard to believe that's all it would be. People don't realize that every day approximately $162 billion of gold trades hands. Another factor that supported gold this year is the belief by the market participants that interest rates were going to drop this year and that the Federal Reserve was going to lower rates at least 5 or 6 times in 2024. If rates go lower, it would hopefully stimulate the economy, which could in turn ignite inflation again, which means gold could go even higher. So in general, if we get any kind of weakness in the price of gold, I would be a buyer for the longer term. We own gold in various forms in our portfolios, and it's up very nicely for our clients. Before I move on to discuss interest rates, I want to share my outlook for inflation for the balance of this year. I am convinced that unless we have an outright recession, which does not appear even close to happening, then inflation will stay above the 2.5% target of the Federal Reserve for the foreseeable future and may even be closer to 3%. Why do I feel this is the case? With all of the stimulus from the U.S. government in road projects and all the onshoring of chip factories and other manufacturing coming back to the U.S., it's hard to envision a slowdown in the economy with all these projects currently underway. These all have long lead times and therefore in the system for a couple of years at a time. Do I believe inflation will go even higher from here? Of course it's possible, but I think that it's unlikely. Why do I say this? Because with inflation running hot and employment running hot, interest rates are not coming down anytime soon. The Federal Reserve will not risk inflation getting hotter from here by lowering interest rates prematurely. If anything, they'll keep rates higher for longer than most people anticipated. This leads me to a perfect segue to talk about the level and direction of interest rates. Here's what I said on the last call at the end of January. I said I believe the Federal Reserve will not cut rates until sometime late in the second quarter, and it's possible they may not lower rates until the third quarter of this year. That has proved to be exactly what has occurred so far. What is interesting is that my comments were not the prevailing consensus back in January. It has become more of the consensus recently. Most economists and strategists believe there may be one cut and maybe a second. The current odds of one cut this year are 99% chance. And there's a 22% chance that there will be a second cut this year. And this is according to the CME Federal Reserve Watch Tool. The other issue is we're getting closer and closer to the U.S. election in November. The Federal Reserve does not want to appear political and adjust rates close to an election. As I mentioned earlier, the Federal Reserve is meeting today and tomorrow, and we'll have a press conference at 2:30 p.m. Eastern on Wednesday with their decision to cut, hold, or raise interest rates. I believe that based on how strong the economy has been and how sticky inflation has been, they will not be lowering interest rates and will probably sound a little hawkish. Hawkish means they will tell the market in so many words that if inflation does not come down from its current levels and employment gains don't soften, they will not be lowering rates anytime soon, and they will do whatever is necessary to get inflation back to their 2 to 2.5% target. If they were to lower interest rates prematurely, it could ignite another round of inflation that might exceed 2022's 9% inflation rate. And that is the very last thing they want to see right now. So the bottom line here is inflation is sticky and higher than the Federal Reserve would like to see. Therefore, in my opinion, they cannot risk reigniting inflation by lowering rates and getting the economy to overheat, so to speak. The Federal Reserve will keep interest rates higher for longer, and this will be the new normal. This goes for mortgage rates as well. The good news, though, for all of us is we're finally earning something on our money market accounts and CDs. Now, for the good part, how does inflation and interest rates affect the stock market for the rest of 2024? First, typically when inflation is hot, interest rates go higher to combat the higher inflation and slow the economy down. When rates go higher, interest rate sensitive investments start to become competition for stocks. Since the low in interest rates in August of 2020, rates have done nothing but go up. 2022 was a very rough year in the stock market, but the real increase in interest rates did not really happen or kick in until 2023. Again, typically stocks have retreated in the face of these higher rates. Why have stocks not fallen with all the increase in rates? The reason is that even after the increase in rates, the economy continues to do very well and is still expanding. This has allowed companies to make more profits and flourish, especially companies that currently have little or no debt. Many of the biggest companies in the S&P 500 not only have no debt, they have very substantial cash on their balance sheets. Just 2 years ago, they were getting paid almost zero interest in cash. Today, they're earning 5%. This is adding to their earnings along with the strong economy. So in the short run, for companies with lots of cash and a growing business, they are in the ideal situation. In the first quarter of this year, companies with all this cash have been buying back their stock at a record pace. Goldman Sachs said it expects 16% growth in share repurchases for the S&P 500 companies to $1 trillion in 2025, following a 13% rise to $925 billion in 2024. 2024. This is excess buying power for stocks. In fact, after earnings were reported recently by several large companies, many companies announced additional buyback of shares in the billions of dollars. I do not see this phenomenon going away anytime soon. With higher interest rates, what group of companies get hurt the most? It is usually smaller companies. These smaller companies usually borrow money from the local bank to expand their business, make payroll, or even buy a new piece of equipment. Most small businesses use credit to do this. They do not have large excess balance sheets of cash as compared to the large mega cap companies. This is why, as of the first quarter, the Russell 2000, which is an index of smaller companies, was down over 2% to start the year. Remember, I titled this call Changing Leadership. The small cap Russell 2000 has underperformed the NASDAQ and the S&P 500 for the last couple of years, mainly because these smaller capitalized companies that rely on debt and do not have excess cash, like the mega caps, large cap stocks. I mentioned tonight's call was titled Changing Leadership. I think a change is about to occur. Not all at once, but very subtly. Why do I think this? Well, because the investors are so enamored with Amazon, Google, NVIDIA, and of course Apple Computer and several other high-tech chip names, these stocks have been bid up to very high prices in relation to their historical trading levels. Technology stocks now make up 30% of the S&P 500. This concentration of technology in the index can last for a while, but at some point things have to go back to more of an equilibrium. Can these large cap stocks go even higher? Of course they can. I just don't think they will outperform. I want to be very clear. I am not saying that they are ready to fall apart. I just believe the market will start to look for stocks that are a little bit cheaper and a better value. I believe the better value in the stock market today lies in this small cap universe of stocks. Now, money managers have been predicting this for several years, and they've been wrong. This is why I think the Russell 2000 or small cap stocks will start to do better for the rest of the year. First, as I mentioned, the big, large cap stocks are overpriced, or at a minimum, they're very high end of their price range. Secondly, the smaller cap stocks are considerably cheaper than those large cap stocks. Third, the small cap stocks are very out of favor and under-owned. What would cause the small caps to have a very big rally? First, lower interest rates. Second, lower inflation. Third, a continuing good economy. And fourth, the Russell 2000 is an out-of-favor investment and is under-owned by most people investing in the stock market. As people anticipate lower inflation and lower interest rates, you will start to see momentum build in the small caps. Again, I want to reiterate, I said this would occur in a quite subtle way. Remember, rates aren't going to fall like a rock, and neither is inflation. It will be very slow to come down. But once the market believes that we have gotten inflation stabilized and interest rates are not going up further and actually are going to start going down, the race will be on, I believe, to own small cap stocks. As Pat mentioned earlier, there's over $6 trillion in cash and cash equivalents as of the end of March. This is a lot of additional purchasing power that could be used to buy stocks when investors feel more confident that interest rates and inflation are about to fall. Now, let me share some of the data and other indicators we're watching to help us decide where we think the market is headed in the short run. A week ago Friday, the sentiment levels had reached a very negative level. Investors were very pessimistic about the outlook for the market, and with the recent news about inflation and bombs being hurled at Israel. In fact, the level of pessimism was similar to October of last year when we became quite bullish. Our other indicators have been improving as well. We added money to the market for many accounts, and just like clockwork, the market had its best week of the year last week. Sentiment is still in the fear zone as of today. As I said, the Fed is meeting this week, but the most important news will be the unemployment report we will get this coming Friday at 8:30 a.m. The unemployment report comes from the Bureau of Labor Statistics. It is a survey of households around the country. Here is the data on non-farm payroll employment so far for 2024. In January, 256,000 jobs were created. In February, 270,000 jobs were created, and in March it was 303,000 jobs. I like to watch the ADP payroll report because I feel like it's a real time and it's a much more accurate reflection of how many new people were added to payrolls. They report every month how many more paychecks they cut versus the prior month. ADP handles paychecks for over 1 million companies. The ADP payroll report for January was an increase of 111,000 jobs. In February, 155,000 jobs, and in March, 184,000 jobs. This report will come out this Thursday morning and will give us insight into what might happen with the data from the government when they release their numbers at Friday at 8:30 a.m. This year, there's been no similarity in the data from the ADP and the government. No one can figure out why the government's data is so different than the ADP data. I'll leave that interpretation to the data scientists. But bottom line, both data sets have been fairly strong all year. The next big data after the unemployment report on Friday will be the CPI report on May 15th. If we get a little softness in the unemployment report and a smaller or better inflation better inflation print on the CPI, this could lead to one heck of a rally, especially in the small cap stocks. What really matters, let me be clear, is the trend of rates and employment, not the level. What I mean is the market just wants to see that the economy is not getting even stronger than it already is. I like to use the analogy of my grandmother cooking in the kitchen with her pressure cooker. When the pressure cooker was too hot, my grandmother would go over to the stove and turn the heat down, which would slow the pressure in the pressure cooker. That is what we need in the stock market. We don't need the heat to completely go off. We just want the heat turned down a little. Before I end the call tonight, I want to leave you with some data that's very encouraging about the future for the market. From the lows in October through the end of March, the market had advanced from the lows to the end of March 25%. As you can see from the chart on the screen, this has only happened 7 times in the past. 3 months later, the market was higher 100% of the time. 6 months later, the market was higher 83% of the time. And 1 year later, the market was up 100% of the time, and the average gain was 19%. Let me share another stat. Whenever the market's gone up 5 months in a row, the market was higher 27 out of 30 times for a 90% success. And the average gain over that period was 9%. The last statistic I'll share tonight is this. I told you how rare it was to have gold and the stock market go up at the same time. Both stocks and gold both rallied 10% over a 3-month period. The question is, do you buy more gold or stocks after this has occurred? The data is pretty clear. Buy stocks. Over the next 12 months, stocks rallied on average 20%. The correlation has actually occurred 20 times since 1928. Now, I've given you some really good statistics, but things change and we must always be flexible because we all know these stats are from the past. And going forward, statistics do not guarantee us anything about the future. In closing tonight, I want to tell you how appreciative we are of the referrals you've sent. It is truly the highest compliment you can give us by referring a friend or another family member. This year, the markets have not only been exciting, but also volatile. I do not see that changing at this time due to the geopolitical backdrop, as well as the upcoming election in the United States for the next president. We are ready and experienced to handle whatever comes our way in the coming months. I want to thank you for joining the call tonight, and I'll turn it over to Pat for closing remarks.
Thank you to those who filled out our survey earlier this year. As a reminder, we have our first guest speaker webinar series upcoming on Thursday next week, May 9th at 12 noon Eastern with a Medicare expert. So please check your email from Melissa Hauer if you're interested, as some of these spots are limited. And our next quarterly market call will be in July, and we look forward to speaking with you all then. Enjoy the rest of your night. Positive client feedback mentioned is not representative of the experience of all clients and does not guarantee future performance or success. Any client comments mentioned were unsolicited and provided by current clients. Clients are not paid or receive any other compensation or benefits for making these statements. This presentation is for informational purposes only. It is not an offer or solicitation to purchase or sell any security or to employ a specific investment strategy. It is not designed for or individually tailored to any particular investor and is not intended to be suitable or the best interest of all types of investors. Opinions expressed in this presentation are subject to change without notice. There is no guarantee that any forecast made will be realized. Commodities, including precious metals, carry substantial risk and have experienced periods of extreme volatility. Investments in commodities may be affected by changes in overall market movements, commodity index volatility, changes in interest rates, or other factors affecting the particular industry or commodity. Past performance is not a guarantee of future results. Investing involves risk, including the loss of principal. Index performance is for illustrative purposes only. Indexes are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested in directly. Data contained herein from third-party providers is obtained from what are considered reliable sources. However, its accuracy, completeness, or reliability cannot be guaranteed. Data is as of the date noted and subject to change. Investment advisory and financial planning services offered through Summit Financial LLC, an SEC-registered investment advisor doing business as Great Lakes Private Wealth. Summit Financial LLC does not provide tax or legal advice. If you require such advice, you should contact the appropriate tax or legal advisor.